everybody, it's Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is October the 7th. Yeah, it's late in the day when I'm recording the video here. It's actually dark, so we're going to have some lighting issues. As you can see, doing a couple of different new things here, trying some stuff out, trying to make improvements to the channel. Been busy over the past few weeks. Lots going on in real estate, lots going on this time of year with respect to personal things and kids in school and whatever. During the month of September and October, it's just a busy time of year for everybody as well. And lots to talk about. But today, I'm going to focus in on really what is the global housing bubble, because I don't really talk about this too much. I pretty much don't talk about it at all. Just focus on the US market. But I thought I'd take some time out today and just get into a little bit of what's going on with the rest of the world, so that everybody can feel better about themselves and their situation, so we know that we're not alone with what's going on in the global housing economy, which isn't looking too good these days. So again, trying some things out here. Who knows what's going to happen? I just thought I'd like to, move things around, shake things up, and try some different formats. We'll see how it goes. All right, this actually is a little map of the world produced by UBS, and UBS is a Swiss investment banking firm, and they do periodic, reports and analysis on the global housing market, and they basically are talking about housing bubbles. So if you take a look at what's going on right here, we're in a housing bubble as far as I'm concerned in the U.S., but these guys drive right down into the city level. All right, so that's kind of what I want to look at here. Basically, you've got the red dots, the kind of burgundy or maroon looking dots, which are the bubble risk locations. The kind of gold yellowy dots are overvalued. The green dots are fair value, and the gray dot, there's only one of them in this market, is an undervalued location. Now, they don't hit every city out there, but they do quite a bit. So we'll say the city with the most risk of a housing bubble is actually Munich in Germany. That's the #1 location. And you've got, if you take a look, you got Frankfurt up there, you got Paris, you got Amsterdam. Amsterdam, you come across the ocean to North America, you got Toronto and Vancouver. Take a look towards the Far East, you got Hong Kong as well too. So those are your kind of like your top 7 locations, I guess you could say, are risks for housing bubbles. Now, I do find this kind of funny because, again, this is based on analysis that they just produced, and I know that in specific locations that they mention here, like for example Vancouver and Toronto, they've already started to see price decreases and devaluation going on. So it's almost like this is telling us what we already know, at least from our perspective here. But again, I'm not too familiar with what's going on in Munich or Frankfurt for that matter. Hong Kong has always been a very high price real estate location. It bubbles from time to time. So again, that's nothing surprising here. From the U.S. side of things, obviously we've got San Francisco, Los Angeles, New York, Boston, Chicago, and they're sort of looking at coastal cities here. They haven't really gone into the Midwest or other locations, but you can see that, again, overvalued cities, San Francisco, Los Angeles, and New York. Chicago undervalued, and Boston is about fair market value according to what they're saying. Now, we know some changes are going on in all these locations. Now, let's talk about San Francisco, for example, because the interesting thing about San Francisco, actually, let me stop here for a sec. You can take a look at this chart, and I'll post this in the community tab section as well too of the video. You can take a look at what has changed from 2018 to 2019. So if we go back and take a look, obviously here's the top 20, I guess you could say, locations. If you go and compare, well, Frankfurt is worse than it was the year before. Munich's about the same. Paris is a housing bubble compared to the year before. Amsterdam is in a situation is the same as last year. Toronto the same, Hong Kong the same, Vancouver the same. London was in a housing bubble previous year. It's not as overvalued now. So there's been a little bit of change, but not a heck of a lot. Most of these locations have remained the same, I guess you could say, color or category, according to UBS here, which is interesting. But going back to the Bay Area in California, and why I find this is kind of interesting is the fact that, a lot of it is based on IPOs. We've read a lot about and listened to a lot of IPOs that have gone on, which are initial public offerings, that have gone on for various tech companies located in the Bay Area over the past year or so. And again, share prices, growth, revenue, whatever, all that's very important to a lot of people. But this is actually affecting the housing market, or will affect the housing market, because a lot of people who live and work in the Silicon Valley Bay Area who are going to get shares, are going to become overnight millionaires, will be looking to purchase property. But the issue is that the IPOs are not hitting as they have hoped. And what I mean by that is, it says, I got an article here from wolfstreet.com, IPOs crash and burn, debris hits housing and the office market. So obviously these companies who felt they'd have a strong IPO, shares would grow the whole bit, everybody make money, you could pull some cash out, etc. Hasn't happened that way. And they look at this as a very sobering thought. Some of the biggest IPOs in the 2019 trade at record lows, and all of the biggest IPOs have seen their shares plunge from their peaks. This is now sending tremors through the housing and office markets in Silicon Valley, San Francisco, and other places that are hot for startup locations. So, example, Peloton, they've actually had an IPO price of $29. They're down to 27, they're down 13% to 24. Dynatrace, Slack Technologies, CrowdStrike, Chewy, Uber. Obviously, we knew that Uber came in strong and it's 33% down from its IPO price now. So, again, this is affecting housing, or will affect housing. Pinterest went public in April. It's fallen 27% from the peak. Zoom video down big time. PagerDuty down. Lyft is down 53% from its peak. So you got lots of going on. And of course, everyone's heard about WeWork, and whatever is going on with WeWork, that's going to affect various locations across the country with respect to its office pricing, and also it's I guess you could say it was going to IPO, but I guess the IPO has been sort of pulled off, or at this point in time it's off the table. So just interesting to note that this really how an economy can affect, or a tech economy can affect housing in a location is kind of interesting as far as I'm concerned. So this really is having an impact in, obviously that helps drive prices up, but what it's also going to do is help to decrease the pricing component of the Bay Area, because all that money won't be there to buy and keep pushing those prices up. So we're going to see some changes probably to that graph maybe next year. New York City, for example. So obviously New York City is always, in the housing bubble area. Interesting fact, though, that New York City's taken a bit of a bath with respect to some of the issues that they've gone through. Manhattan home prices down 8% in Q3, the largest slump since 2011. And really, a lot of this is attributed to the mansion tax. You can see there's a lot of articles here, excuse me, that have apartments and condos, of these, usually it's over, a couple $1 million. They're plummeting now. The reason being because there was a new mansion tax that was, well, first of all, we know there's overbuilding in New York. We know prices were already dropping in New York City. They've already hit their peak. They're dropping. A lot of foreign investors aren't coming to the table, and a lot of them are actually pulling out. But with respect to SALT, state and local taxes, and this mansion tax, we've seen a big change in the marketplace for New York City. So just remember that. If you take a look at the price trends here, you've got Q3 average and median prices from 2018, and we can take a look at Q3 2019, how the average is down about 300,000 and change, and the median is down about 136,000, 135,000 as well too. So this is having an impact, and really what it boils down to is that mansion tax is hitting, I guess you could say, I believe there's a mansion tax on purchases of $2 million and above. So if you're losing the SALT deductions and you're going to hit with a mansion tax, you're really probably going to think about how and where you're going to buy and what your price point is, et cetera, et cetera. And I can tell you that you can take a look at this big, this spike here was Manhattan luxury home sales in basically June. It obviously hit a peak and then plummeted once July hit, because that's when the mansion tax of $2 million, for homes $2 million or more was put into place. So clearly, this is an issue, and this is going to push prices down because people just aren't going to pay those prices. And if you want to do deals, it's going to be lower and lower. I guess you could say maybe you'll probably see more movement in the sub $2 million market than you will for $2 million above. Now, I guess you could say people who can afford that may go, hey, it's a price I got to pay to be in some of these condos and some of these high rises or these new developments. But in the end, it just goes to show that people are being a little more picky about where they're placing their money in real estate. People are looking at the tax deduction, the mortgage interest deduction, and things like this is affecting their bottom line. And also, we know that a lot of people from this area have relocated to different states because of these issues right now. So that will affect the housing market as time goes on, but definitely want to show that this is interesting. And again, when we go to that map from UBS showing the housing bubble, yeah, it's a housing bubble, but my expectation is that that bubble will be bursting or starting to burst as we talk right now, and we might see some changes when they reproduce that map. So again, kind of interesting. One thing I noted though is that where is China in all of this? So the only thing that we saw was Hong Kong. Now Hong Kong, is still technically a separate entity from China. So obviously UBS reported on that, and it's always been a housing bubble area. But there's a lot of issues going on with Chinese real estate over the years, and the fact of the matter is they've overbuilt, and there's a lot of real estate bubbling that's going on. My only question is, why didn't UBS actually include any of the Chinese cities in the housing bubble report? Maybe there's a political agenda there, I don't know, but that's really what they didn't include it. So what can I say? I mean, we just have to sort of, I want to tag it in here. Obviously, home sales are falling in China. They want redevelopment and money staying in China. Obviously, we know that there's been changes in the money leaving China. The flight capital isn't coming out anymore. There's restrictions on that and penalties and other issues with respect to having, from banks pulling money out, etc. But in the end, we see that the sales are dropping in tier 1, tier 2, and tier 3 cities. And this, I think, is interesting when you take a look at this part of the information base here, that they say it's hard to overstate just how crazy China's real estate market is, as 25% of the country's GDP comes from construction. That's a quarter of the GDP is based on construction, which means they're building a lot of either homes or infrastructure, office complexes, whatever you want to have there. They're building a lot of it. All right, 80% of the nation's wealth is held in domestic property holdings, which is quite a bit. That's $65 trillion of wealth, which is double the size of the economies of every G7 nation combined. So now, granted, China has over 1 billion people, which seems to, so you'd have larger volumes. But when you take a look at all the money that's parked in real estate, it's actually pretty scary. It's on a little bit of a cliff or precipice, whatever you want to call it. Now, this is the interesting part. China has 65 million vacant residences, but the prices remain high even in tier 2 cities. I can tell you that over the past couple years, I've read that developers were reducing their, I guess you could say, if you bought in a condo development, for example, at a certain price here, developers reduce price to get out and cash out, that certain banks and the government stepped in and would not allow them to reduce because it would devalue the people who already bought. So it's the government really is propping this market up and kind of playing a game, which is kind of weird. But again, we don't hear much about this anymore, but this is significant of what's going on in China. And I just want to note that it wasn't included, again, in the UBS report that they produced. Now, more information. The nation is staggering under massive real estate debt, 3.4 trillion worth of it, and 47.1% is tied up in vacant properties. So, okay, and the people who borrowed the money are not receiving rental income. So what's going to happen? All right, well, they're not even living in the properties, which means, for me, this is like just destruction coming at an all-time huge level here. The banks are going to have a massive wave of defaults coming sometime soon. If you're not living in it and you're speculating and you've got these properties you got to pay your mortgage on and financing on, and no one's paying you rent, what are you going to do? You're going to eventually get tapped out, and you're going to have to stop paying, and all cash is going to break loose. So again, 65 million vacant properties. Think about that. Think about our situation with the homeless crisis and what's going on. They've got 65 million vacant properties sitting there doing nothing. And again, how that affects the economy and the social architecture out there, I don't know. But that's a lot of vacant properties that are going to be headed for a lot of trouble in the very near future. So just wanted to note that. There you go. Something interesting that kind of comes with respect to all, we're talking about housing, bubbles and this and that. Well, the mall vacancy rate hit a 8-year high. And I don't normally talk too much about the economy with respect to what's going on sort of everyday economical news, because there's just so much, it would take forever. But this is interesting because Mall vacancy rates hit 8-year highs. Why? Because of so many store closures. It's going to have a trickle-down effect. So here's how I look at it: is the fact that stores close, which obviously produces vacancies. When stores close, that means people are getting relocated, or losing their jobs, or being laid off, or taking hours or pay cuts, which means they're going to have problems making ends meet, which means they will also eventually have probably either rental or mortgage problems down the road. So when you take a look at what's actually happened this year, the announced or completed store closures in the U.S. over the years, well, look where we're at for 2019. There's about 11,000 store closures have been announced or are happening as of right now in 2019. So I don't know what that equates to as far as jobs and personnel, but if we got this great economy and wages are apparently strong, or unemployment numbers are low, what's happening to all these people that are losing their jobs? Like, why is that not being reflected in the numbers here? So I don't get that. There's probably smarter people than me that can answer that question, but my point is the 11,000 store closings going on this year, that's got to affect us somewhere in the rental market, i.e. you're not paying your rent because you can't afford it, you don't have the money, or the mortgage market, which is the housing crisis component. You're not paying your mortgage because you can't, and eventually that's going to go into default. So these are things that are adding to the stress, the pressure and the stress in the housing market that will manifest a little bit later on. So please keep that in mind. All right, another interesting tidbit of information here. And who do we have here? It's my favorite guy. Okay, Mr. Robert Shiller, or Dr. Robert Shiller, the Nobel Prize winning, I said Peace Prize before, and somebody corrected me on that. The Nobel Prize winning economist from Yale, who's the co-creator of the S&P CoreLogic U.S. Home Price Index, all right, which we talk about every month here. So one of the things that he really got into the past few interviews was talking about narrative. So he talks about things in a narrative. He wants the story to come out about the economy, about housing, whatever. Well, he's warning now of a blooming recession narrative. So I guess he's not saying we have a recession. He's saying there's a narrative, which means the story is coming together. And he believes the chance of that happening before next November is 50%. I guess you could say recession will spell the end of the current presidency, and the history of economic narratives basically saying the frugality narrative overwhelmed purchasing decisions. Nobody wanted a new car in their driveway when their neighbors were desperate. Another narrative is that when your next door neighbor is suddenly laid off and can't find a job and has to sell their house, that startles people. And if you think this is going to be a long haul, then of course you will cut back on vacations and other optional expenses. So basically he goes into deeper and talks about if rates go any more negative, people will withdraw cash. But when it boils down to it, it's just one more comment that this guy is talking about, one more category, one more area that's contributing to the economy. And we know that when we have recession fears, we have yield curve inversions. We've talked about that a few times. There's so much information out there on YouTube that you can look this up yourself, and I'm sure a lot of you already have. But the point is, consumer confidence drops. And when consumer confidence drops, what do? They don't buy big ticket items. And what's the biggest ticket item you can buy? Is a house. So it will affect the housing market, and we already know that we're bubbling in many locations, and we know that those locations are starting to crack, and we've already sort of gone over the peak, and we're sort of working our way down now. We're going to see more and more of that as the fall hits. So in another couple of weeks, we'll have more Case-Shiller information, and more home price information. We'll be able to check that out. But this is kind of what goes on. So every so often, for me, again, he likes to speak in, or he likes to categorize things in narratives now. So he's building a story for us. He's wanting us to learn the story, understand the story, and almost fill in the blanks for the story and think about what the ending's going to be. We don't have a crystal ball, but we do kind of have an experience that we've dealt with over 10 years ago, which was a housing, I guess you could say, boom, bust, crash, and crisis, right? Millions of people lost their homes to foreclosure. Millions of people did short sales. We had a complete, I guess you could say, generation that saw this and will be affected by it for years to come. So there's a big shift in what's going on right now. But again, I look at this as, he's laying the groundwork and sort of, I guess you could say, educating us and dropping his nuggets of information without saying exactly what he really wants to say. The narrative allows us and other writers and journalists to fill in the blanks as to what's going to happen in the future. So I look at that as, hey, he's giving us an indication, the sign that things are not going to get better anytime soon. In fact, they're going to get worse, and it's up to us to realize that and deal with it accordingly. So there you go. All right, so thank you for the views, and thank you for the likes and the comments. Please share the video. I'd love you to help my channel grow. And again, if you're not a subscriber, please subscribe. It really would help me. I'd love it if you could, and help us grow and help me do more of these videos and get the word out about what's happening in the housing marketplace. Now, I do have a couple of programs out there if you're interested in real estate training. One is a Never Pay Retail program, which is a generic, well, I wouldn't say generic, which is a very all-encompassing retail and investing sort of entry-level education course that I have. Then I have, of course, my advanced short sale training course, which is called the Short Sale Cash Connection. So if you want more information about both those two, you could send me an email at Randy@Luxury Short Sales. That would be great. Now, I will admit that sometimes I'm not very good about responding very quickly, just because the past month and a bit, I'll be very upfront, we've been really busy doing a lot of things here. So deal flow's picked up, a lot of things going on, trying to do a lot of things property based. It's deals and real estate first, video and stuff second. That's the way it has to be. However, I do owe people some communication, but if you do send me an email, include your telephone number. It saves me one step having to email back saying, hey, how do I contact you? How do we talk, etc., etc. If I haven't got back to you, I will. I'm going to work on that this week and this upcoming weekend. A lot of growth on the way here, a lot of things happening, but I can tell you that in our market here, and other markets across the country, I certainly see a shift in sort of the, I guess, how could I put it, shift in the mentality, shift in people wanting to know more, wanting to do more, wanting to get involved in real estate, knowing that they see things happening. How I look at it is that you actually have an early adopter benefit. If you start doing this or learning this now, when stuff really hits, you'll be ahead of the game before the masses jump in. So please keep that in mind. All right. And also, I do need help with distressed properties and finding them and working with me in various locations across the country, because I have some clients who are looking, specifically well-funded clients who will buy properties if it makes sense. So if you're in these locations, Portland, Sacramento, Riverside, LA, Phoenix, or Tucson, let me know what you got. Let me know what's going on. If you want to be involved with me, contact me. I have data for all those locations. I can tell you who's facing foreclosure and who you need to market to, as well as Las Vegas, Raleigh, Charlotte, Houston, Orlando, and Jacksonville. Now listen, I can get to most locations in Florida fairly easily. However, if you're already, again, I'm in Tampa, so that's where I'm. I don't need any help here. But example, Orlando, I'm about an hour away, Jacksonville a few hours away. So if you've got opportunities there, reach out to me. There's more cities, but these are kind of the main ones I wanted to focus on now. Reason being, I have either, I can get contacts there, or I can get data that can help us find the distressed properties in these locations. So that's a scoop. So if there's any interest, reach out to me. I'll tell you what we have to do, how you have to figure out how to work with me, etc. But I think this is a great opportunity, and I can tell you right now that this is happening more and more. More people are reaching out saying, I want to find distressed homes, I want cheaper real estate to live in, or I want to purchase stuff for an investment down the road. How do I do it? Can you help me? Of course I can. And just reach out to me and we'll start the process. Anyway, thanks very much. Hey, this is a change. I'm trying some new stuff here to improve the channel, and tell me what you think, and I'll be doing some new stuff in the future. So take care. We'll look forward to speaking with you later on this week.